Hello students and welcome to the lecture. So students, as we know that in the previous lecture we had started our discussion over the banking awareness practice questions, right? And that lecture was our part 1 and this lecture is our part 2. In part 1 we had covered 25 questions and we have seen their answer and detailed explanation. I hope you have revised that lecture in a well enough manner before you have come for this lecture. As many times I have told you, it is for your own benefit. Okay, so let's begin this lecture. And basically, we know that in this we are practicing questions, okay, which we called as a practice question so that we could ensure that our preparation is good. So, here also in this lecture, we will cover practice questions, okay, and at last, we will take the summary of these questions also. But before starting this, as usual, we have our small disclaimer over here. So the disclaimer is like, the images used in a slide deck are for educational purposes only. We respect the intellectual property rights of the original creators and owners of these images. If you are the owner of any of the images used in this deck and have any concerns or issues, then please contact us at sathee@iitk.ac.in and we shall remove the image. Now let's begin. So here you can see the first question is there. What is the full form of the term LIBOR as used in the financial banking sector? Local Indian Bank offered rate, London India Bureau of Regulations, Liberal International Bank official issue, London Interbank offered rates, none of these. To answer this, you will have 10 seconds, then I will provide you the answer. So your time starts now. Okay, the time's up. The correct answer of this is D, London Interbank offered rate, LIBOR. Explanation is, so the London Interbank offered rate, it is actually a benchmark interest rate that indicates the average rate at which major global banks are willing to lend to one another in the international interbank market for short-term loans only. It is calculated based on submissions by a panel of banks and is widely used as a reference rate for various financial instruments, including loans, derivatives, and securities. Okay. If we talk about the significance, LIBOR serves as a key benchmark for setting interest rate on various financial products and crucial for the functioning of global financial system. Thus, the full form of LIBOR is London Interbank Offered Rate. Okay. Now, the question 2. Explain the term FSDC, which is used in the financial sector, like Financial Security and Development Council, Financial Stability and Development Council, Fiscal Security and Development Council, Fiscal Stability and Development Council, none of these. To answer this, again you will have 10 seconds. Time starts now. Okay, the time's up. The correct answer of this is FSDC stands out for Financial Stability and Development Council. If we go by the explanation, then we could see FSDC. It is the Financial Stability and Development Council, which is an apex body got set up by the Government of India in order to strengthen and institutionalize the mechanism for maintaining the financial stability and promoting the financial inclusion and development. What is the purpose of this? So, the Council aims to enhance coordination among various financial sector regulators, such as the Reserve Bank of India, RBI, Securities and Exchange Board of India, SEBI, and Insurance Regulatory and Development Authority of India, IRDAI, to address issues related to the financial stability and development. Thus, FSDC stands out for the Financial Stability and Development Council. Okay, then let's move on. Question number 3. Which of the following rates ratio is not covered under the RBI monetary and credit policy? Bank rate, exchange rate of foreign currency, repo rate, reverse repo rate, cash reserve ratio. Again, to answer this, you have 10 seconds and your time starts now. Okay, the time's up. The correct answer is exchange rate of foreign currency. If we go by the explanation, we could say RBI monetary and credit policy. The Reserve Bank of India implements monetary policy through various tools and rates that influence liquidity and credit conditions in the economy. Some of the key tools include bank rate, the rate at which the RBI lends money to the commercial banks; repo rate, the rate at which RBI lends fund to the banks against securities; reverse repo rate, the rate at which the RBI borrows money from banks. Then the cash reserve ratio, or CRR. It is a percentage of a bank's total deposit that must be kept in reverse with the RBI, or Reserve Bank of India. After this, the exchange rate of foreign currency. While the RBI plays a role in managing the foreign exchange reserves and could intervene in the forex market, stands out for foreign exchange market, the exchange rate itself determined by the market forces, thus supply and demand. Therefore, it is not directly controlled under the RBI's monetary and credit policy. Thus, the rate ratio that is not covered under the RBI monetary and credit policy is exchange rate of foreign currency, because it is directly controlled by the supply and demand. Got it? Then, when a loan is granted by a bank for purchase of white goods, it is called consumption loan, white good loans, consumer durable loan, all of these, none of the above. To answer this, you have 10 seconds. Time starts now. Alright, the time's up. The correct answer is consumer durable loan. Explanation. Consumer durable loan. This is a type of loan which is specifically granted to the individuals for the purchase of durable goods like appliances, electronics, and other white goods. These items are expected to last for several years, which makes them durable. Consumption loans. While these terms can refer to the loans used for consumption purposes, which is a broader category and does not specifically denote loan for durable goods. White goods loan. This term is less commonly used and could be considered as a subset of consumer durable loans, but it is not the standard term. All of these, since consumption loan and white good loans are not the standard or precise terms for loans specifically targeting the durable goods, this option is not correct. Thus, the most accurate term for a loan granted by a bank for the purchase of white good is consumer durable loan. Question number 5. Which of the following method is being adopted by banks for calculating and applying interest on the savings bank accounts? Options are on monthly products based on minimum balance between 10th and last working day. The daily balance is counted and interest is paid accordingly. On average quarterly balance. On average half-yearly balance. None of these. To answer this question, again you have 10 seconds and your time starts now. Okay, the time's up. The correct answer is daily balance counted and interest paid accordingly. Explanation is daily balance method. Many banks calculate interest on savings bank accounts based on the daily balance. This means that the interest is accrued daily and the amount calculated on the actual balance present in the account each day. At the end of the interest period, usually it is monthly or quarterly, the accumulated interest is credited to the account holder's account. Other methods. On monthly products based on minimum balance between 10th and last working day. This method is not commonly used for calculating savings bank interest. On average quarterly balance. While some banks may use this method, it is less common than the daily balance method. On average half-yearly balance. This method is not typically for saving accounts. Therefore, the most widely adopted method for calculating and applying interest on saving bank account is daily balance counted and interest is paid accordingly. Question number 6. The main function of IMF. Give financial investment loans to developing countries. Act as a private sector lending arm of the World Bank. Help of solve balance of payment problems of member countries. Arrange international deposits from bank. None of these. To answer this, again you will have 10 seconds. Time starts now. Okay, the time's up. The correct answer is C. Okay. If we go by the explanation, then we could say the first is the IMF's role. The International Monetary Fund primarily aims to ensure the stability of international monetary system. One of its main functions is to provide the financial assistance to the member countries facing balance of payment problems. This assistance helps countries stabilize their economies and restore their growth. Other options. Give financial investment loans to the developing countries. While the IMF does provide financial assistance, it is not specifically focused on investment loans. That role is more associated with the World Bank. Then, act as a private sector lending arm of the World Bank. The IMF is a separate entity and does not serve as a lending arm for the World Bank. Arrange international deposits from banks. This is not a primary function of the IMF. None of these, since option C is accurate, so this option is automatically got incorrect. Thus, the main function of the International Monetary Fund is to help solve balance of payment problems of the member countries. Next question is question number 7. Which of the following is not a part of scheduled banking structure in India? Money lenders, public sector banks, private sector banks, regional banks, state cooperative banks. To answer this, again you will have 10 seconds. Time starts now. Okay, the time's up. So the correct answer is money lenders. Explanation. First, scheduled banking structure in India. Scheduled banks are those that are included in the second schedule of the Reserve Bank of India Act 1934. These banks must meet certain criteria, including maintaining a minimum paid-up capital and reserves. Components of scheduled banks: public sector banks, These are banks where the government holds a majority stake and part of the scheduled banking structure. Private sector banks. These banks owned by private individuals or organizations and are also part of the scheduled banking structure. Regional rural banks. Established to serve rural areas and included in the scheduled banking structure. State cooperative banks serve as a cooperatives and rural areas and part of the scheduled banking structures as well. Now, who are money lenders? Money lenders operate in informal sector, not regulated by the Reserve Bank of India. Do not qualify as scheduled banks. Therefore, correct choice for what is not a part of the scheduled banking structure is money lenders. The rate of interest on saving bank account is stipulated by the concerned bank, the Reserve Bank of India, Indian Banks Association, Government of India, Banking Codes and Standards Board of India. To answer this, again 10 seconds you have. Time starts now. Time's up. Correct answer is the concerned bank. Go by the explanation. Autonomy of banks. Each bank in India has the authority to set its own interest rates for saving bank accounts. This means that the rates could vary between different banks based on their operational strategies, financial conditions, and market competition. Influence of RBI. While the Reserve Bank of India does play a significant role in the overall monetary policy and could influence interest rate indirectly through tools like repo rates and reverse repo rate, it does not specify the interest rate that banks must offer on saving accounts. Other options. RBI. RBI regulates the banking sector and sets the framework for monetary policy, but does not set specific saving accounts interest rate. Indian Banks Association. This organization represents the interest of banks in India but does not have the authority to set interest rates. Government of India. The government could influence banking regulation but does not directly determine the interest rate offered by the banks. Banking Code Standards Board of India. This board establishes codes for banking practices but does not set interest rate. Conclusion of this. The rate of interest on savings bank account ultimately determined by the concerned bank reflecting their policies and the market conditions. Question number 9. Under provisions of which one of the following act does the RBI issue directives to the banks in India? Reserve Bank of India Act, Banking Regulation Act, Essential Commodities Act, RBI and Banking Regulation Act, none of these. Again 10 seconds, time starts now. Time's up. The correct answer is Reserve Bank of India and Banking Regulation Act. Explanation. RBI Act. Reserve Bank of India Act 1984 provides the framework for the establishment, regulation and functioning of the Reserve Bank of India. Empowers the RBI to issue directives to the banks regarding various operational aspects, monetary policy and regulatory measures. Banking Regulation Act, we talk about. This act, enacted in 1949, specifically regulates the functioning of commercial banks in India, provides the RBI with the authority to issue guidelines and directives to ensure the soundness and stability of the banking system. Combined authority. The RBI operates under both the RBI Act and the Banking Regulation Act. While the RBI Act outlines the general functions and powers of the RBI, the Banking Regulation Act details the regulatory framework for banks, allowing the RBI to issue directives to maintain financial stability and consumer protection. Conclusion. Thus, the RBI issued directives to banks in India under the provisions of both the RBI Act and the Banking Regulation Act. So, option D is the correct choice. Question number 10. Which one of the following tools is used by RBI for selective credit control? It advises banks to lend against certain commodities, advises banks to recall the loans for advances against certain commodities, advises banks to charge higher rate of interest for advance against certain commodities, discourages certain kinds of lending by assigning higher risk weights to loan it deems undesirable. None of these. To answer this, again 10 seconds you have, time starts now. So correct answer is A. Advises bank to lend against certain commodities. Explanation. Selective credit control refers to the tools and measures used by the Reserve Bank of India to direct credit towards specific sectors or commodities that are deemed important for economic stability or growth. Option B. Advising banks to recall loans for advances against certain commodities implies a tightening of credit rather than promoting it. This action would be counterproductive to the goal of selective credit control, which aims to encourage lending to the priority sectors, not discourage it. Correct approach. Advising banks to lend against certain commodities aligns with the purpose of selective credit control, where the RBI encourages lending to the essential sectors such as agriculture or small industry. Advising banks to charge higher interest rate would deter lending and not a method of promoting selective credit. Assigning higher risk weights related more to risk management and capital requirements, not directly to the selective control. Question number 11. For which one of the following are loan products, teaser loans offered by the banks? Education loan, commercial loan, loans against security of gold, retail, trade loans, home loans. 10 seconds, time starts now. Correct answer is E. Home loans. Explanation. Teaser's loan definition. Teaser loans are type of loan where the borrower is offered a low initial interest rate for a specific period, after which the rate increases. Approach makes the loan more attractive at the outset, as borrowers could benefit from lower monthly payments initially. Common usage. Teaser loans most commonly associated with the home loans mortgages. Lenders offer these loans to attract buyers in the housing market, especially when they want to stimulate demand for real estate. Mechanism. For example, a bank might offer a home loan with an initial interest rate of 5% for the first 3 years, which then adjusts to the higher rate after that period. This strategy could be appealing for first-time homebuyers who might struggle with larger monthly payments, but confident in their ability to manage payments after the teaser period. Other options: education loan. These typically have fixed interest rate and do not commonly feature teaser. Commercial loans. While they may have varying interest structures, teaser rates less common in this sector. Loans against security of gold. These usually have straightforward interest rate based on market conditions, do not feature teaser rates. Retail trade loans. Similar to commercial loans, these do not typically offer teaser rates. Question number 12. Under provisions of which one of the following acts has the Reserve Bank of India power to regulate, supervise and control the banking sector? RBI Act, Banking Regulation Act, Negotiable Instrument Act, RBI and Banking Regulation Act, none of these. To answer this, 10 seconds you have, time starts now. The correct answer of this is Banking Regulation Act. So the Banking Regulation Act, by explanation, this act is specifically designed to regulate and supervise the banking sector in India, provides the Reserve Bank of India with the authority to oversee commercial banks and ensure their stability and compliance with regulation. The act covers various aspects including the licensing of banks, governance, capital requirements, management of banking operations, and the powers of the RBI to issue directive to the banks. RBI Act 1934. While the Reserve Bank of India Act established the RBI and outlines its roles and responsibilities, primarily focused on the central banking functions such as monetary policy and currency issuance, does not provide the detailed regulatory framework for the banking sector that the Banking Regulation Act does. Other acts: Negotiable Instrument Act deals with instruments like checks and promissory note, does not focus on banking regulation. RBI and Banking Regulation Act. While the RBI operates under both acts, the Banking Regulation Act is the primary legislative framework for regulating banks. Conclusion: the specific powers of the RBI to regulate, supervise and control the banking sector are derived primarily from the Banking Regulation Act, making the B correct answer. Question number 13. Credit rating is, options are these, 10 seconds, time starts now. Okay, the time's up. Correct answer is, it is used to rate the borrowers while giving advances. Like if we go by the explanation, credit rated definition, credit rating is an assessment of the creditworthiness of a borrower, could be an individual, a corporation or a government, reflects the borrower's ability to repay loans and the likelihood of default. Purpose of credit rating: banks and financial institutions use credit ratings to evaluate the risk associated with lending to borrowers. Higher credit rating indicates a lower risk of default, while a lower credit rating suggests a higher risk. This evolution helps banks more informed decisions regarding loan approvals, interest rates, and lending terms. Other options used to work out performance of the employees. This is not related to the credit rating. Employees' performance typically evaluated using different metrics. Used to calculate the number of excellent audit rated branches. Different assessment process and not related to the credit rating. Not to used in any bank. This is incorrect as credit ratings widely used in the banking environment. Necessary before giving promotion to employees. While performance evaluations may be part of promotion criteria, credit rating especially pertain to financial assessment, not employee promotions. Question 14. Insurance service provided by the various banks commonly known as investment banking, portfolio management, merchant banking, bancassurance, and microfinance. To answer this, 10 seconds you have, then I will give you the answer. Time starts now. Time's up. Correct answer is bancassurance. By explanation, bancassurance definition refers to the partnership between a bank and insurance company, allowing the bank to sell insurance products to its customer. This model combines banking and insurance services, enabling customers to access a range of financial products in one place. Features of bancassurance: convenience. Customer could purchase insurance products directly from their bank, making it more convenient. Cross-selling. Banks could leverage their existing customer relationship to offer insurance, enhancing their service offering and generating the additional revenue. Other options: investment banking involves service related to the raising capital for companies, underwriting and facilitating mergers and acquisition, not directly related to the insurance. Portfolio management refers to the management of investment on behalf of client, does not specifically pertain to the insurance services. Merchant banking focuses on providing financial services to companies, including underwriting and fundraising, rather than insurance. Microfinance involves providing financial services to low-income individuals or those without access to traditional banking, unrelated to the insurance services. Question number 15. The rate on which bank borrows from the Reserve Bank of India is called SLR, CRR, interest rate, bank rate, repo rate. To answer this, 10 seconds you will have. Time starts now. Okay, the time's up. Correct answer of this is the bank rate. Explanation: bank rate. This is a rate at which the central bank, in this case the Reserve Bank of India, lends money to commercial bank, key tool for controlling the money supply and influencing interest rates in the economy. SLR, statute liquidity ratio. Minimum percentage of a commercial bank's net and demand liabilities that must be maintained in the form of liquid cash, gold or other securities, does not refer to borrowing. CRR, cash reserve ratio. Percentage of a bank's total deposit that must be maintained as reserves with the RBI in cash. SLR is not a borrowing rate. Interest rate is generally term referring to the cost of borrowing money, not specifically tied to borrowing from the Reserve Bank of India. Repo rate. This is the rate at which RBI lends money to commercial bank against security. It is similar. The question specifically asks for the rate at which banks borrow from the RBI, which is more accurately defined by the bank rate. Question number 16. As we know, RBI is the apex bank of India. Similarly, the apex bank of US is called. Options are there. 10 seconds you have to answer. Then I will give you the answer. Time starts now. Federal Reserve. Explanation: Federal Reserve, commonly referred to as the Fed, it is the central banking system of the United States, plays a crucial role in the country's monetary policy, regulates banks, maintains financial stability, provides financial services. Central Bank of USA, it is a phrase is accurate, it does not the official name of institution. Bank of America, commercial bank and not the central bank of the US. Central Bank of USA, similar to option B. None of the above, like if option A is correct, then automatically this will be incorrect. 17. Which are the following included under the statutory period assumptions? SLR, CRR, bank rate, repo rate. Options are there. 10 seconds you have to answer. Then I will give you the answer. Time starts now. Okay, the time's up. Correct answer is only 1 and 2. Question number 18. Which among the following is most important functions being done by SLR in recent times? Options are controlling of inflation, caution against bank failures, financing government deficit, adjustment of liquidity, none of these. 10 seconds to answer, then I will give you the answer. Time starts now. Time's up. Correct answer is C. Question number 19. How bank rate is different from repo rate? Options you can see. 10 seconds you have to answer. Time starts now. Time's up. Correct answer is A. While repo rate is a short-term measure, bank rate is a long-term measure. Explanation: repo rate at which the central bank lends money to commercial banks against securities, primarily used for short-term borrowing, typically overnight. Changes in the repo rate often used as a monetary policy tool to control the money supply and influence inflation. Bank rate at which the central bank lends money to commercial banks without any security. Generally used for long-term loans, the bank rate is more stable and reflects the long-term cost of borrowing. Question number 20. If a bank ties up with a retail vendor and then both of them sponsor a credit card, such card would be known as retail credit card, vendor credit card, co-branded card, cashback card, none of these. 10 seconds to answer, then I will give you the answer. Time starts now. Time's up. Correct answer is C, co-branded card. It is a credit card that is issued in partnership between a bank and a retail vendor. This card often come with benefits specific to the vendors, such as discount, rewards, or point for purchases made at the vendor's location. Retail credit card usually refer to a card that is specific to a single retail store or chain and may not be necessarily involve a bank in coordinating partnership. Vendor card, not commonly used in the context of credit card. Cashback card, type of card offers rewards in the form of cashback for purchases, does not specifically denote a partnership between a bank and a vendor. Question number 21. Which is the first credit card facility to be recognized worldwide? Visa card, MasterCard, dinner card, none of these. 10 seconds to answer, then I will give you the answer. Time starts now. Time's up. Correct answer is Visa card. Explanation: Visa card recognized as one of the first credit card facility to achieve widespread acceptance and recognized worldwide. Originally introduced in 1958 as the Bank American card and rebranded as Visa in 1976. MasterCard also became widely recognized shortly after Visa, but Visa was the first to gain significant global traction. MasterCard is a debit card service, not a credit card. Dinner card often rests as a dinner's club, one of the first charge cards, but did not achieve the same level of universal recognition as Visa. Question number 22. With reference to the prepaid credit cards, which among the following is correct statement? To answer this, again you will have 10 seconds. Time starts now. Time's up. Correct answer is only P. Question number 23. What does the circus logo on ATM debit card significance? To answer this, 10 seconds you will have, then I will give you the answer. Time starts now. Time's up. Correct answer is D. Have cash access facility in and outside the India. Explanation: Circus logo F1 associated with the Circus network indicates that the ATM debit card could be used for cash withdrawals and transactions not only within India but also internationally. Allows users to access their funds at ATMs around the world, making it convenient for both domestic and international usage. Question number 24. What is the time period during which no interest is charged on a credit card? Grace period, term period, loan period, selection period, none of these. To answer this, again you will have 10 seconds and I will give you the answer. Time starts now. Time's up. Correct answer is grace period. Explanation: Grace period is a time frame during which no interest charged on a credit card balance if the full payment is made by the due date. Typically, this period lasts from the end of the billing cycle until the payment due date. If cardholder pays off the entire balance within this time, they could avoid interest charges on their purchase. If the balance is not paid in full, interest will accrue on the remaining amount. Question number 25. Reference to the credit card number, which digit indicates the credit card network? Initial 2, initial 4, last 2, last 4, none of these. 10 seconds you have, time starts now. Time's up. Initial 2. Explanation. First few digits of a credit card number known as the issuer identification number or bank identification number used to identify the credit card network and the issuing bank. Specifically, the initial 2 digits indicates the card network, example Visa, MasterCard, etc. For example, Visa cards typically start with the 4, while MasterCard starts with numbers ranging from 51 to 55. Here we have finished the topic. So now it's our time for a summary. We have talked about LIBOR, FSDC, RBI monetary policy, consumer loans, interest calculation, savings, IMF main function, scheduled banking structure, savings account interest rate, RBI directives, selective credit control, teaser loans, RBI regulations power. Thereafter, we have talked about the crediting, bancassurance, interest rate borrowing, Apex Bank of USA statutory presumptions, then SLR functions, and this and that. So with this note, we have finished this topic. It is advisable to all of you. Kindly revise the facts and figures in a proper manner. Okay. With this note, let's end this lecture and thank you.